Now, before we jump into the euro currencies and the land of currencies and some other European data, first we'd like to remind you, please like, share, subscribe. This is going to be a topic that is near and dear to my heart as I don't understand the euro or the strength and I can understand it to a point, but why at these levels, I will never understand. Everybody who's ever traded or been a portfolio manager, and I've been lucky enough to be both. When the euro's on my do not trade list, because if I'm long, it goes down. If I'm short, it goes up. And I never understood why it got the premium it's gotten. And here's just another example. So that's a little bit about me. But now let's go into the euro. So this gentleman, Robin Brooks, he's fantastic. I used to follow him when he was at Goldman. He's now at the IIF. These are some of the charts that he put together. I recommend following him. He puts out some great currency stuff, specifically on the global macro. So let's just take this for what it is. So, okay, the euro is strong, and Europe is weak, and they're trying to stimulate the economy, and Germany is an exporting nation. So as an exporting nation, if you want a recovery, you want people, and by people, foreign companies, foreign governments, to be able to afford your products. As the euro strengthens, the ability of you buying it goes down because your currency doesn't go as far. So now let's take this in two different directions. So let's look at the broad nominal trade weighted euro. So the euro to dollar, which at the time of this writing was $1.20, currently $1.21. So the euro has strengthened against the dollar by another 10 pips. So we're right now at 1.21 even. So that when you look abroad, many currencies are denominated or pegged to the dollar. So as the dollar weakens, then their currency is going to weaken. So when you look at the broad weighted, so it's $1.21 for us, but it's $1.50 for those. So it's almost doubled for people that are trying to buy or are purchasing from Europe, France in general, especially Germany. So this is going to be an overhang because as the euro strengthens against the dollar, you have this inherent problem. And now what does Lagarde do at the ECB meeting to try to drive down the euro? I don't have that answer. I can opine on it. I think she will do everything within her legal and semi-legal ability to push down the euro and try to bring I would say is $1.10 the target, maybe. I'm sure they would like it to be below that, but at the same time, there is a concern about the US dollar. If there's a concern about the US dollar and you need FX reserves, well, what are you going to buy? Well, are you going to buy euro? And so how much euro you're going to buy? So is this a bid in the dollar because people are looking to own euros and less dollars to help diversify FX currencies? What is happening out there that is really helping to drive the disconnect? Because, look how broad that disconnect is in that left chart. Now let's go to the other side and let's look at the narrow trade weighted euro, which is really $1.30. So again, still in a broad setting, an inherent problem, and there's always a snapback. Now, I say always a snapback, but when you look at the years going back to essentially 2014, 2015, we got a big divergence and it has stayed the same. And this is something that the euro needs to do, or Europe needs to do, to help stimulate the economy. How do they stimulate the economy? How do they can get inflation? How do they get things up and running? This is not helping. And they're going to have to find a way to adjust that as the dollar continues to weaken and the euro continues to strengthen. Problems will arise as their exports come under pressure. Now, that'll be great for U.S. exports. So on a selfish way, the U.S. will benefit because now you would rather buy stuff from us than others, and that would help our exports. And if you go back and look at our in the first segment, we talked about how in the PMI data, new export orders from the U.S. are up. And they've been up the month over month. They continue to grind higher, which is again a net benefit for us. But it's at the expense of someone else. And that's something that I think they're going to look to try to adjust in some shape, way, or form December 10th. So that's right now, everybody is positioned short dollar, long euro, and that could be a very interesting trade heading into the December 10th meeting, which is a Thursday. Stay tuned because it's going to be an interesting one. Now, when we look at inflation, again, coming to the inflation side of the equation, inflation slowed. And again, this is the Eurozone, so this is different pieces. But when we look out over time, the Eurozone continues to see inflation decline. Now, inflation declining is relative. We have to look at where is inflation declining, because this is looking at all items year over year on a percentage basis. They want this back towards that, let's call it 1 to 1.5%. But where is there inflation? And that's why we look at Euro area annual inflation and its main components. So this is 2020, November 2019, and June through November 2020 estimates. So when we look at negative 30 basis points, so negative 30.3% on all items, but food and alcohol, tobacco, up 1.9%, processed food, up 1.3%, unprocessed food, up 4.2%. So you're telling me there's no inflation, but yet things I spend money on are inflated in price. But then energy is down 8.4%. So the diesel I'm buying, the gasoline I'm buying, the LNG I'm buying in some shape, way, or form has fallen in price. But the things that I spend money on every day to live has gone up in price. Again, coming to full circle to what we talked about, energy has been a big driver of deflation. And as crude sits at 45, as we have these different levels of pressure, which I don't think we're going to get a meaningful move higher, even as the dollar has weakened. This is going to be something that has to be considered when you're looking at what are your inflation targets and what are your main components, because energy has been a deflationary factor for you, which is inherently good for the consumer, even though but as we know with lockdowns, they're driving less, they're moving around less. So the net benefit to them has declined as the stuff that they're actually purchasing day in, day out to live has gone up. Again, these are the inconsistencies that we continue to try to point out and highlight when we're considering where is food. Like look at unprocessed food in June, 6%. Food and alcohol and tobacco, net 3.2%. This is where I struggle with the inherent narrative that inflation is low or from inflation is this. I know what I spend money on. I know what you spend money on. You know what you spend money on. How do you see prices going down? And I'd love to hear in your comments, have you seen prices going down? I can say that my credit card bill is down 10, 20%, but that's not going out to eat. That's not traveling as much. That is not a food level. And when I did the work, my spending on food is up 15%. And it's not because we're buying more. It's just because the prices have inherently gone up. And that's I think the overarching issue as we go forward. Now, when we look at looking in Europe again, household gross disposable income versus consumption. So disposable income has fallen and individual consumption expenditures have fallen more, which is, again, we're seeing this household gross disposable income versus consumption. So the consumption has fallen, disposable income has fallen less. This is a positive. When we think about this inherently means that, okay, I've lost some income, but I'm spending less. So that means you're saving more. Now, if you're saving more, that is money on the sidelines that can come back into the market, that can be pushed back in. Again, this is some positive that we're trying to find and trying to look at, which could help bridge that gap and get us to the other side when you're looking at Europe and trying to incentivize the consumer, getting spending back on, and again, trying to get that GDP number and provide the stimulus to again, trying to get the economy jump-started. But it's going to take a weaker euro to get people to want to buy more exports, want to buy more stuff. And this is going to be a factor that needs to be weighed as we head into the December 10th meeting. So European job opportunities remain fairly weak, but again, they've flattened out. France has recovered a little bit, even though we've seen an increase in lockdowns, which is a positive. Vacancies are increasing, which is actually good, which means that we're getting more turnover, which vacancies also means that you're looking to hire. Germany has done fairly well. These are these positive swings back to the upside. And if you look at last week, we talked about PMI. Some of the manufacturing remains fairly positive, while services remains fairly weak. But again, these are small things that's showing some signs of life. The problem is we remain stuck at these, let's call it, June, July into August levels. Now, the fact that they didn't decline with new lockdowns is a fairly positive thing, but it's going to be a net problem as we look forward and as we try to understand, okay, well, where are things going? And just a quick thing, and we'll talk about this again on the Frac Spread Count show. But miles traveled in the U.S. Interstate were down 5% last week, but trucking miles were up 5%. So again, this is also something that we've seen in Europe, where Europe, Germany, the UK specifically have seen their toll miles either flat versus the beginning of the pandemic or up, which again is supportive in terms of kind of where this can go and hopefully starting to get to the other side of this. But when we look at expectations, real GDP growth rates, and government stringency, so the government stringency, as we've been talking about, continues to increase. Spain, Italy, France is up towards that 75%. Germany has just extended theirs, so they'll remain in this level. But the projections on forecasts of the euro area, as we've seen April versus October has shifted lower. 2021 has been taken down. I think 2021 will come lower. And that's, again, the inherent problem when we start looking out and trying to project what is 2021, what does 2022 look like, how quickly can we get AstraZeneca, Pfizer, Moderna, how quickly can we get those vaccines into market? Will people take them? We saw with France in one of the previous segments how the French are a little pessimistic. What does this mean? What is the adoption rate? How quickly do people get back to some sort of normalcy? And when we get back to normalcy, how quickly do jobs return? Prices, salaries increasing. These are things that will take time, which is why I think the extended downturn will go beyond just 2021 and well into 2022 and beyond. So, and now this is just looking at Europe, but as in the next segment, we'll start looking at emerging markets and some of the flows that have really adjusted, because it's an interesting backdrop in terms of some of the emerging market love versus some of the pressures that will start to arise, especially as developed markets continue to struggle, which is, where do they get a lot of their raw materials and semi-finished goods? Emerging markets. So we'll talk a little bit more about that correlation and where some of those issues will arise.